Hello guys, so as you all know, today we are looking at Forex Masterclass, a beginner's course for Forex traders. So if you are looking forward to become a profitable Forex trader from beginners to pro, then you are at a good place. I recommend this class for you. You take your notebook, you take your pen as you jot things down, because this is going to be a comprehensive class, a serious one of course, which people are paying for, but then we've decided to bring it out for free so that our viewers or our followers can also learn forex trading and take it to the next level. So this course is prepared by Kwame Forex, as we all know, our guru, our bossu, our senior man Bakope, Kwame Forex, and then Ken FS. So let's move into the class. Our course outline for today, that is a course 1.0. We are going to look at what Forex is. What is Forex? And then 2, the Forex market. We will also look at Forex trading. That is the third one. And then market participants. That is the people who participate in Forex trading. We will also look at base and then code currency. And then lastly, we consider Forex brokers. So we are moving on to the next slide. Very good. So what is Forex? Probably I know you have heard about Forex trading, and then you will be wondering what Forex is. So when we say Forex means foreign exchange, as it says here. Forex means foreign exchange. So foreign exchange is the exchange of one currency for another. When we say Forex, in short, it simply means exchanging of one currency for another. Example, I have the Ghanaian cedi, and then I need the American dollar or the US dollar. So if I exchange my Ghanaian cedi for the US dollar, it is foreign exchange. Yeah, foreign exchange. Again, if you have the pounds and then I have the yen, and then when we swap or we exchange our currencies, you take my pounds, I give you my yen, it is foreign exchange. So that is everything about Forex. I believe you are getting it. Let's move into the next slide. Okay, Stu, what is Forex market? The Forex market is a global market or platform where individuals, businesses, and institutions like the banks, those are the buyers and the sellers, they trade, that is buy and sell currencies. So what I want you to know is that everything about this course is going to be currencies. Everything about Forex is currencies. So if we say anything buying and selling, then we are dealing with currencies. So when we say the Forex market, it is the platform, the marketplace where buyers and sellers, people who participate in the Forex market, they meet to buy and sell their currencies, or they exchange their currencies. I believe you are following very closely. We are moving into the next slide. Now, what is Forex trading? I believe you are waiting for this session. What Forex trading is. Now, when we say trading, let's first look at trading. When we say trading, it involves the act of exchanging, that is the buying and selling assets, goods or services, with the intention of generating revenue or making profit or achieving a goal. So that is the basic definition for trading. When someone decides to buy or sell something with the intention of making profit or getting something valuable from it for their personal gains or their personal interest, that is what we call trading. Now let's look at what Forex trading is. Now Forex trading is the process of buying and selling or exchanging of one currency for another with the goal of making profit. So here when we say Forex trading, then what we are trying to mean is that exchanging of currencies, that is buying or selling of one currency for another currency with the intention, with the aim or with the goal of making profit or getting money as profit from it. I believe you're following very closely. Then let me remind you, if this is your first time watching us, subscribe to this channel, Kwame Forex. We have more updates for you. Yeah, we have more updates for you. And I believe by the time we are done with this class, you have everything you need to be a pro Forex trader. Yeah, everything you need to be a pro Forex trader. Thank you. Let's move into the next slide. Alright, so here is a practical example of how traders make money from the forex market. How traders are going to make money from the forex market. Let's break this down so that I believe by the end of this, you will just love forex trading. You will love forex trading. Suppose you are a forex trader and you expect the euro, that is the EUR, to appreciate against the US dollar, that is the USD. You are expecting that the euro will appreciate against the USD. That means that the exchange rate, the euro is going to rise and then the US dollar is going to decrease. That is what you are expecting from the market. Then when you get this, you decide to buy the euro USD pair. That is, you are exchanging your euro. Sorry, you are exchanging your USD for euro. You have the USD and then you want to buy the euro and keep it. So that when you decide to buy the euro USD pair, hoping to profit from the potential increase in the euro's value. I earlier on said that you are expecting that the euro will increase in price as compared to the US dollar. So what you're doing is that you have the US dollar or you have the dollars, and then you think or you know that the euro will increase in price. You are then going to exchange. The foreign exchange is going to take place here. You're going to exchange your US dollar for the euro currency. You are going to sell your US dollar and then you buy euro, that is the euro currency, hoping that when there is increase in price for the euro, you are going to make profit from it. Let's proceed. Now, we are assuming that your initial trade, that is before you enter into this trade or you trade on the market, you are going to buy 1,000 euros at an exchange rate of 1 euro to, which is equal to 1.1 USD. You are going to buy 1,000 euros, which you are going to buy one per rate of 1.1 USD. So that means that you are going to pay 1,100 USD for 1,000 euros. Let me repeat here. Initial trade, that is, you are starting this trade with an amount of 1,100 USD. That is buying 1,000 euros, which one cost 1.1 USD. I believe you are getting me. Very good. So now let's move. Now, immediately you bought this, there was exchange rate fluctuations. That is, few days or hours later, the exchange rate fluctuates and the euro appreciates against the USD. The new exchange rate then becomes 1 euro equals 1.2000 USD. Don't forget, we bought it at 1.1 and now the rate has increased to 1.2. So when it happens like this, you will then decide to sell your euros. Let's move into the next slide and see what happens over there. Now, you then decide to close your trade on the market. So now, don't forget, we bought the euros at 1.1. So we paid 1,100 USD. And now, the price for the euro has increased to 1.2 USD. So you decide to close your trade by selling the 1,000 euro at the new exchange rate. The new exchange rate here is 1.200 USD. Now, you sell your 1,000 euros at an exchange rate of 1.2 USD per 1 euro. You will then receive 1,200 USD for the euro. I'm reading the second line. You receive 1,200 USD for the 1,000 euros. Now, let's check your profit calculations. Your profit will be the difference between the amount you received and the amount you paid. The initial amount you used to buy the euro, and then after you close the trade, the amount you are going to receive. The differences in these two amounts will be your profit. So let's look at it. The profit is equal to amount received minus amount paid. So the amount we received is 1,200 USD, and then we pay 1,100 USD. Now, after this calculation, we can come to a conclusion that our profit is equal to 100 USD here. Our profit here is equal to 100 USD. Therefore, in this example, you made a profit of $100 by buying the euro USD currency at a lower exchange rate and selling it at a higher exchange rate. I believe you understand everything here. We are looking at the market participants. That is the people who take place in the market. Let's read from our slide. Market participants. Which people participate in trading of the foreign exchange market? Now, which people or who participate in this forex trading we are talking about here? Forex participants are individuals, organizations, or institutions that buy, sell, or exchange currencies in the foreign exchange market. So, here from our definition, people who participate, whether individuals, group of people, organizations, institutions, or whatever group they are, if they come to the market, that is the forex market, to transact or to trade or to do marketing over there, then they are part of the forex participant or the forex market participants. So let's move to the next slide to see who these people are. So here are the main forex participants. One, we have the commercial banks. Commercial banks are the largest forex participants, accounting for approximately 80% of all forex transactions. They provide forex services to their clients, including currency exchange, trade finance, and then hedging. So this is what the commercial banks they do, and then they account for approximately 80%. So most people that trade the financial market or the forex market, commercial banks have the largest percentage over there, because they are the largest people that trade over there. So maybe any commercial bank you can mention them. They trade on the financial market with the intention of making profit. Don't forget, we said anybody that comes to the market, forex market, to trade is trading to make profit or benefit. Yeah, so the commercial banks trade. And then also the central banks, they are responsible for managing their country's monetary policies, including setting interest rates and regulating the money supply. They participate in the forex market to stabilize their currency, manage foreign exchange reserves, and implement monetary policies. So from these central banks, they are the people responsible for stabilizing your currency rate. So if your currency rate is depreciating against a different currency, then you should know that the people who trade for your central banks, they are not doing well at all. Yeah, they are not doing well. Because here we are saying that the central banks are responsible for managing their country's monetary policies. So they manage the monetary policies of their country, including setting interest rates and regulating money supply. They participate in the forex market to stabilize their currency. So if your currency is not stable, then there is an error with the trading of your central bank. I'm not going much into this. I'm just teaching. Very good. And then they also manage foreign exchange reserves and then implement monetary policies. Let's move to the next slide. Investment banks. So any banks, most of the banks that do investment, let me put it that way. Most of the banks that do investment or where we invest, they are into forex trading. So they will take your money and then they will trade for you. Then at the end, they will give you some return from what they earn from the market. So investment banks provide forex services to their clients, including corporations, institutions, and individuals. They offer currency exchange, hedging, and speculative trading services. Let's move on to the next participant. Hedge fund. Hedge funds are investment vehicles that use forex trading as part of their investment strategy. They aim to generate returns through currency speculations, hedging, and then arbitrage. So as time goes on, you will delve more into this style so that you will know more. We will be making use of all these words. So as we keep on using them, you get more understanding for it. Retail traders. Now, retail traders, they are we here who are also trading. We the individuals trading in the forex market. We are just someone in his room, someone in his house who has decided that I want to be a forex trader. Like you watching me right now, who wants to trade on the forex market? You are a retail trader. We are retail traders. So let me read. Now, retail traders are individual traders who participate in the forex market through online trading platforms. They typically trade with smaller amount of capital and may use leverage to amplify their trading positions. So when we say using leverage to amplify your trading positions, you see the banks, the other big institutions, they have the money to trade on your own. But you and I, we don't have over billions of dollars to trade. You see, some banks are trading trillions. The central banks, the hedge funds and the rest, they are trading trillions. And you and I we are just going there with our $100, our $500. Some will even trade $10 or $20. So we need to do leveraging. When I say leveraging, it means that trading higher amounts that is bigger than your money. Let me break this down. Example is, you have 100 euros or $100, and then you want to start selling, let me say, perfumes. You want to start selling perfumes, but your $100 can start selling very few amount of perfume. Do you understand? But then when we say leverage, you can borrow and then add it to your money so that you can buy more perfume and sell. So the more perfume you buy and sell, the more you make money. The same way applies to the leverage here. You can go to a bank and say, hey, I have this $100 and I want to start this business. So can you give me $1,000 to add to my $100 so that I will return it later? Now you are buying there, you are taking $1,000 from the bank, then you are adding to your $100 to trade or to sell your perfumes. Now if you make even 20% profit from what you're going to buy, the profit will be applied to $100,000, not only $100. The profit you're going to get, the 20% profit will be applied to $1,100 and not only $100, because you are leveraging. You've borrowed $1,000 and you've added it to your money. And the same way, if it doesn't go in your favor and it drops, it affects you with the leverage too. So what we do is we leverage on our money to make more profit. As we keep on going, you understand most of these things. You don't worry at all. Let's move to the next slide. Corporations. Corporations also participate in the forex market to manage their foreign exchange exposure. They engage in hedging, speculative trading, or currency exchange to facilitate internal trade. Let's move on. Now we have the institutional investors, such as the pension funds, endowments, and insurance companies. They participate in the forex market as part of their investment strategy. So if you give your money to your pension funds, they engage your money, or they will take your money to go and trade so that they can make huge amount of profit from the money you're giving them. Let's say that's net. That's what they're doing with our money. Very good. They use the forex trading to diversify their portfolios, generate returns, or hedge against currency risk. Let's proceed. We have the brokers and dealers. Brokers and dealers are intermediaries that facilitate forex transactions between buyers and sellers. They provide trading platforms. Liquidity, and market access to clients. Now let's look at the 9. Government agencies. Government agencies such as the Export-Import Banks and development agencies participate in the forex market to facilitate internal trade and development. Then let's move on to another slide. These forex participants interact with each other through various channels, including 1. Forex markets, 2. Brokerage firms, 3. Banking systems. Now we are going to look at base and then quote currency. So in forex trading, every currency pair consists of 2 currencies. Before you can trade, you must have something you are buying or you are using to buy something. So if you go to the market to buy, let's say you go to the supermarket to buy biscuits, you are sending money to collect the biscuits. Do you understand? So the same thing happens here. We have 2 currencies. That is exchanging of 2 currencies, sending one and then collecting one. These are what we call the base and then the quote currency. So let's first look at what base currency, also known as the transition currency, what it means. Now, definition. The base currency is the first currency in each currency pair. So every currency pair you see, or every pair of currency you see, the first one, that is, let's say Euro USD. The euro is the first pair, so the euro is the base currency. Now the role of the base currency, it is the currency being bought or sold. Example, in the euro USD currency pair, the euro is the base currency. So if you are buying euro USD currency pair, then it means that you are buying euro. Or if you are selling the euro USD, then it means you are selling this euro here. Now let's move on. Quote currency, also known as a counter currency. Now there is a second currency in every currency pair. Let's look at the role of the quote currency. It is the currency used to quote the price of the base currency. Example, in the euro USD currency pair, the US dollar is the quote currency. So here, from what we first looked at, we said the base currency is either what we are buying or what we are selling. Then it means here, when we are dealing with the quote currency, we are selling this euro here to buy this year, or either we are buying this year to sell this year. I believe it's making sense. Very good. Let's move on. So how the base and the quote currency work together? We have what we call the price quotation. That is, the price of the currency pair is quoted as the amount of the quote currency required to buy 1 unit of the base unit. This will take us back to the first example I made, how forex traders make profit from the forex market. You can go back and then rewatch that video. You will get a clear understanding of what is happening here. And then buy and sell. When you buy a currency pair, you are buying the base currency and you are selling the quote currency. Conversely, when you sell a currency pair, you are selling the base currency and then buying the quote currency. Very good. Example, the euro USD is equal to 1.1. The euro USD is equal to 1.1. This means that the price of 1 euro here is equal to 1.1 USD. The price of 1 euro here is equal to 1.1 USD. In this example, the euro is the base currency. The US dollar is the quote currency. The price quotation is 1.1, meaning that 1 euro is equal to 1.1 US dollar. As I said earlier on, if you buy the euro USD currency pair, you are buying euro and selling US dollar. If you sell the euro USD currency pair, you are selling euro and then buying the US dollar. Forex brokers. Let's look at what forex brokers are. Forex brokers are intermediaries between traders and the forex market. So before you and I, we can trade on the financial market, we need a broker. Before you and I can trade on the forex market, we need a broker. This broker will give us access to trade on the financial market. We cannot trade our small amount on the market. No, it can be possible. But then, these brokers will allow us leverage. Don't forget, we spoke about leverage. Allow us leverage on our money so that we can trade money that is not ours, but we can make profit and keep it for ourselves. So these are what the brokers do for us. Now, the forex brokers, they provide us access to the forex market. They give us access to the forex market. Then they give us trading platforms. They give us liquidity. That is the movement of price on the market. They give us liquidity. Then also, they give us tools to manage our risk. They give us tools to manage our risk. Don't forget, in every business you venture, there is risk. So the forex brokers will give you tools to manage your risk. They give us customer support, and then education, and then research as well. How to know good forex brokers? Now, good forex brokers should be regulated. There must be a rule or a law that regulates or that governs, that controls every forex broker. Then the market must be liquid. That is, it must provide you with price movement on the financial market. It must have competitive spreads, reliable trading platform. It must have good customer support. And then they must also be transparent, very clean, transparent. They don't need to hide anything from you since you are dealing with money. Let's move on. Then how forex brokers make money? So one, they do with spread. When we talk of spread here, spread is the amount you are buying a currency pair, and then the price you are buying a currency pair, and then the price the broker will allow you to buy. Let's say a price is at $1. So in your mind, you are buying a currency pair at $1, but then the broker will place you at a place of $1.1. So that is the spread. And then commission, they will charge you commission. That is, when you place any trade, there is some small amount of money they are going to charge you. That is the commission. And then you have swap fees. Swapping is when you hold a trade overnight or over the weekends, they have the money they are going to charge you for swapping. That is when you are moving from one day into the another. They are going to charge you for that. You call that swap. And then they may have other fees that they are going to take from you. Thank you very much for staying with us throughout till this far. Let me still remind you, this channel is Kwame Forex. Like I said earlier on, we are bringing you exclusive and an intensive Forex masterclass to take you from beginner to a pro Forex trader. So if you want to advance your Forex trading, then I'm urging you to stay with us. By the time we are done with this, you will just love everything about Forex trading. Don't forget to subscribe to this channel, Kwame Forex, and then also give us a like. You can hit the bell notification icon so that whenever we upload the next episode of this class, you will be the first person to get notified. I am your boy, Ken FS. Peace out. Bye-bye.